In today's episode, I want to talk to you about the Kiddie Tax, okay? We're going to talk about what Kiddie Tax is, who's actually subject to Kiddie Tax, and how to report it, okay? Because I deal with taxpayers who give me unearned income for their children, and they're like, hey, can you just add this to my return? And it doesn't always work that way. We can choose to make that election, but there are certain criteria that must be met. Okay?
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Family, welcome to episode 88 of the Tax Relief with Timalyn Bowens podcast. If you've been listening for a while, somewhere within the past 4 years, you know that I am dedicated to filling the tax literacy gap, one taxpayer at a time. And in this episode, I want to make sure that we look at a preventative measure to protect your children from unnecessary taxes. Okay. Now, the majority of time I talk about tax relief for taxpayers who owe the IRS and they can't afford to pay in full. But we want to make sure that as we are earning money or investing and receiving income that way, that it's protected and we know what to expect. That is why in today's episode, I want to talk to you about the Kiddie Tax, okay? We're going to talk about what Kiddie Tax is, who's actually subject to Kiddie Tax, and how to report it, okay? Because I deal with taxpayers who give me unearned income for their children, and they're like, hey, can you just add this to my return? And it doesn't always work that way. We can choose to make that election, but there are certain criteria that must be met. Okay, so first things first, the Kiddie Tax is something that the IRS created through the help of Congress, of course, to help protect them from taxpayers evading tax by passing along investment income to their children. If you're not familiar, investment income such as capital gains from the sale of stock, tangible assets, intangible assets, dividends, those things are taxed differently than the income that you earn through a job or through a business. So, the lower your overall income is, you could potentially pay 0% tax on that unearned income. So there were taxpayers who would intentionally pass those things to their children to keep it at a lower tax rate. And the IRS was like, we're a little slow, but not stupid. So the Kiddie Tax was created. And with this, it takes your child's unearned income. So like I mentioned, capital gains. So from the sale of assets, dividends, and interest. And instead of it being at that 0%, it actually is going to get taxed at the parent's marginal rate instead of the child's 0. Okay. So I hear a lot of people saying, well, the wealthy get this, the wealthy get that. They don't get to avoid paying tax on that investment income. Okay. Now, for this tax year, 2026, when we are looking at what is going to actually trigger the Kiddie Tax, it's if the child's interest, dividends, or other unearned income total more than $2,700. If that's not you, this isn't going to be necessary for you to listen to, but you can listen for education purposes. All right. Now, I have clients, and these are tax preparation clients as well as rep clients whose children do have well above $2,700 in earned unearned income with capital gains, dividends, and interest. So, if that's you, keep listening. This may be subject to Kiddie Tax. Now, we would need to look at Form 8615 to see if it's going to be subject to Kiddie Tax and how much we're looking at. Okay. Now, the other thing here, if the child's only income is interest and dividend income, okay, and it totals less than $13,500, then you may be able to elect to include that income on your return rather than file it on your child's return. Now, if you make the election to file it on your return, then you need to look at Form 8814, which is the parent's election to report child's interest and dividends. Okay. That Form 8615 that I mentioned earlier for your child's return is tax for certain children who have unearned income. Now, I do want to point out that when we're seeing how much should be paid in Kiddie Tax and all of that, we will need numbers from you, the parent's 1040, and how much you have in capital gains, interest, and dividends to put on the child's Form 8615. Okay, so it is important that the same preparer, same office is actually preparing these returns so that all of the information is there. Okay, so if you're working with somebody and they're preparing your child's return as well, they are going to need to push your return all the way through so that they'll be able to see what they need to see to put on the child's Form 8615. All right, now, when we're looking at this, we have to take a few other things into consideration as well. Okay. Who is a child? The 30-year-old that still lives at home is not a child for Kiddie Tax purposes. All right. They would still file their own 1040 and include the unearned income there. We're looking at children who are yet dependents, even if they're over the age of 18. Now, let me explain, because again, there's criteria that must be met. If they're under the age of 18, the tax is going to apply regardless of how much the child earned. So if they had that summer job or not, or they worked during the school year, or how much financial support they receive. When they reach 18, it can still apply if the child's earned income. So again, this would be wages from an after-school job, salary, tips. If that income does not make up more than 50% of their own financial support for the year, they will still get hit with the Kiddie Tax. Okay. Now remember, if they're providing more than 50% of their financial support, they're not actually your dependent, are they? But not going to go down that rabbit hole. We've already talked about that in another podcast episode. But if the child is between the ages of 18 and 23, and they are a full-time student whose earned income does not exceed 50% of their own living and educational support, then they also may have to deal with Kiddie Tax. Okay. Now, when we look at this, it's taxed in tiers, right? So it's not going to all get hit at the parent's, yours, likely, if you're listening to this, marginal tax rate. The first $1,350 of the unearned income is going to be completely tax-free, just like if they weren't going to be subject to the Kiddie Tax. Okay. And the next $1,350 is going to be taxed at the child's lower tax rate. Okay. Now, anything above the 2,700 is going to be taxed at the parent's marginal tax bracket. And again, when we are filling out that form 8615, we need numbers from the parent's return so we can determine how much tax that the child is going to actually get hit with. Okay. So again, going back to this form 8615, this is for children with unearned income that was more than $2,700 for the tax year. So for 2026, if that's your child, keep listening. If the child was under the age of 18 at the end of the tax year, or if the child was between the ages of 19 and 23, honestly, I should say under the age of 24, okay? And if they're a full-time student and if they didn't have earned income that was more than half of their support, okay? Or they don't have to be in college as a full-time student if they're only 18, okay? At least one of the child's parents was alive at the end of the tax year, which is likely true if you're listening to this. Now, when we're looking at who is a parent, again, there's different criteria for that, talked about in a different episode. The child is required to file a tax return for the tax year, and the child does not file a joint return for the tax year. So that's referring to married filing jointly, because we do have people who get married at 18, right? Or 20, 21. But if they're a full-time student and yet living in their parents' house, which I have seen, not just on TV, then we may have a situation where they're still going to be subject to that kiddie tax because they're not providing more than half of their own support. Okay. Now, something else to take into consideration is something called NIIT, which is net investment income tax. This is roughly 3.8% on the lesser of the net investment income or the excess of the modified adjusted gross income over the threshold. Now, I know that was a bunch of taxonomies. If you have a child who has over $2,700 in investment income, unearned income, my advice to you would to be seek out a tax professional to prepare this return. Okay? Because after calculating the kiddie tax and then seeing if they're going to get hit with the NIIT, it's a lot, okay? And you want to make sure that it's done correct because you don't want to set up your child for tax problems in the future, okay? Now, I mentioned earlier that you as the parent may be able to elect to report the child's interest and dividends. And let me not say that because maybe you are the taxpayer who is deemed as a child in this situation and you don't understand why the tax software is telling you that you have this thing called kiddie tax. Maybe you're the one listening to this and you're going back to your parents to tell them about it. So I apologize for only addressing the parents because you may be the child listening to this in the situation. This unearned income may be able to go to the parent's tax return with that form 8814. Remember, it's an election that must be made, and it can be done if at the end of the tax year your child was under the age of 19 or under age 24 if they're a full-time student. If the gross income was less than $13,500 for the tax year. If your child had income only from interest and dividends, okay, no estimated tax payments were made for your child for the tax year, and no overpayment from the previous tax year was applied to the current tax year under your child's name and social security number. No federal income tax was withheld from your child's income under the backup withholding rules. Your child is required to file a return unless you make this election. Your child doesn't file a joint return for the tax year, and you're the parent qualified to make the election, or you file a joint return with your child's other parent. So if you are not filing a return joint with the child's other parent, make sure that you are the one that is supposed to be claiming the child that year if you choose to make this election. Okay. Now, I hope that's not as clear as mud because it truly is my intention to educate on these podcast episodes. So please let me know on whatever podcast platform that you are listening from if you found this information helpful. It would also mean the world to me if you would rate this podcast on whatever platform you're listening. If it's Apple, if it's Spotify, even if you're on YouTube, give me a thumbs up. Let me know that you love the episode. And sharing is caring. Help me to reach my goal, fulfill my mission to fill the tax literacy gap one taxpayer at a time. There are a lot of people investing right now, and you never know who may be investing for their child and they've triggered the Kiddie Tax rules and they don't even realize it. If you would share this with your friends and family members who have children or may even have a child in college you may be investing, that would most definitely make my day and help me fill the tax literacy gap one taxpayer at a time. I'll see you all in the next episode. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.